Most people lose thousands of dollars making simple investment mistakes that they don't even realize. Over the years, I have figured out how to spot and fix these costly errors before they wreck your savings. By fixing these 8 costly mistakes, I have seen regular folks boost their investment returns by over 30%. And today, I'm going to share these simple fixes with you. What's up, everybody? I'm Rashida, your guide to smart money moves. From the age of 17, I have grown my portfolio to 7 figures, and I did this all on a police officer salary. I'm on a mission to show you how you can get there too, so let's go. Investing does not have to be complicated. You do not need a finance degree. You don't need to spend hours researching stocks every day, but you do need to avoid some common mistakes that trip up almost everyone when they start investing. I have talked to hundreds of people over these years, and I keep seeing them make the same mistakes over and over with their investment accounts. I have researched this topic for over 2 decades, and I've learned that these are not complex errors. They are simple slip-ups that can cost you thousands or even hundreds of thousands of dollars over time. But by the end of this video, you will know exactly how to fix each of these mistakes. I'm going to leave you with some simple practical tips that you can use right away to improve your investment results for years to come. So let's go ahead and jump into the 8 costly mistakes that investors make and how to fix it. But before we do, please take a second, see if you have subscribed to the channel, and if you haven't, please consider hitting that subscribe button. I'm here every single week to help you better understand the world of money, and I give you my tips and strategies to help you turn your income into real wealth. Now, we all dream of buying stocks when the prices are low and selling when the prices are high. The perfect time to buy, the perfect time to sell, the timing that makes the most money. And many people spend hours poring over charts, reading predictions, and trying to guess where the market is heading next. But what you have to understand is that timing the market is nearly impossible, even for the pros. A study actually found that the average investor earned only about 3.7% over a 10-year period when the funds they invested in actually earned 6.5%. And you may be asking, well, how is that? It's because they jumped in and out at exactly the wrong times. I want you to think back to March of 2020 when the market crashed because of the pandemic. Think about how many people sold when the prices were low, locking in those losses only to miss the huge recovery that happened right after. Therefore, if you don't want to be one of those people, using dollar cost averaging actually takes away that pressure of perfect timing. So what you want to do instead is, instead of trying to find the perfect moment, just invest a set amount regularly, no matter what the market is doing. When prices are high, you are buying fewer shares with those same dollars. And when prices are low, you're buying more shares with the same dollars. And so over time, this approach actually tends to get you much better deals on your investments. Now, this method is not exciting, it's not sexy, it's not flashy, but it works. What this actually does is turns the market ups and downs from your enemy to your friend. But the key is you need to stick to your strategy even when the markets get scary. The hardest part is continuing to invest when the markets are falling, because your gut is going to tell you to stop, to wait, to let things calm down. But this is exactly when sticking to your plan matters the most. So what you should be doing is set up automatic investments that are going to happen without you having to think about it. That's going to take the emotion completely out. Don't have to make a decision, and your future self is going to thank you. So ask yourself, am I trying to outsmart the entire market with perfect timing, or am I building wealth steadily no matter what the market does? Now, moving on to our second mistake that most investors make is to neglect your tax advantaged accounts. Opening a regular investment account is super easy. A few clicks online, a simple app on your phone, complete freedom with your money. And many people put all of their money into these regular standard brokerage accounts to start out without even realizing what they are missing out on. But ignoring your tax advantaged accounts are definitely costing you thousands of dollars in extra taxes. And so let me show you what this means. If you are investing $6,000 every year into a standard brokerage account and you're in the 24% tax bracket, you are going to pay taxes on those earnings every year. And after 30 years at an 8% average return, you'll end up with $566,000. But if you made the exact same investments inside of a Roth IRA, that money would grow to $745,000. That is almost $180,000 more completely tax-free. Therefore, using that 401k and that IRA, it helps you to keep a lot more of your money. So what you'd want to do is start with your employer's 401k if they provide a match to your contributions. That should be your priority because that is literally free money and you can't leave that on the table. Then once you've met that contribution amount, you want to look at putting any additional funds into an IRA. The traditional IRA is going to give you a tax break right now, all right? And if you go with the Roth IRA, you're going to have tax-free money later on in retirement. And so stop thinking of these accounts as tax shelters. These are actually wealth boosters that help you to grow your money faster by keeping the government's hands off of those investment gains. Now, with these tax advantage accounts, you do need to be aware of the basic rules about contribution limits and withdrawals. Now, as of 2025, you can put up to $23,000 inside of that 401k, and you can put up to $7,000 in an IRA. And if you're over the age of 50, the government actually allows you to put in even more money into those accounts, and they call those catch-up contributions. Now, taking the money out of these accounts early usually means paying some sort of penalty, but the government does allow exceptions to these rules in instances like buying a first home or education costs and some other situations. So make sure you know all the rules before you try to take that money out early. And so as a beginner investor, you need to ask yourself before you open your account is, are you giving away thousands of dollars, even hundreds of thousands of dollars in extra taxes by not using these special accounts? All right, now number 3 on the list is to start investing without an emergency fund. Now, the stock market has absolutely helped many people build wealth over time, but the key is you have to stay invested, okay? The market rewards patience, and you're allowing compound interest to work its magic. And so many eager beginner investors want to put every single dollar that they can into the market to maximize those potential gains. But if you are doing this without an emergency fund built up, any unexpected expenses are going to force you to sell those investments, often at bad times, because life is going to happen. Cars break down, roofs leak, people lose jobs. And so when these emergencies happen and you don't have any cash saved up, you are going to be forced to sell those investments, and oftentimes the prices are going to be down. And so again, looking back at the pandemic market crash, many people had to sell their investments at market lows simply because they did not have any other money to handle basic expenses. And so having 3 to 6 months of expenses saved up and set aside in a high yield savings account, that is going to help protect your investments in the long run. So before you put another dollar into the market, make sure you have that emergency fund set up again in a high yield savings account. Remember, we don't do just the standard savings account because they don't pay any interest. This emergency fund is going to be crucial for your long term because this fund is going to give you that ability to keep your investments working through market downturns and personal money challenges. And I'm not saying to go overboard with the cash. 3 to 6 months is usually enough. If you want to get real aggressive with the cash, 12 months. Anything beyond that needs to go toward your investing. You don't want to have too much cash sitting on the side. And so if you are investing, just ask yourself, if you lost your job tomorrow, would you need to sell investments at potentially bad prices? Hey guys, just a quick note. In today's complex financial world, making smart decisions with your money has never been more important. And so that's why I've teamed up with Money.com, your trusted guide to financial clarity. Money.com Newbies.com's mission is simple. It's to help you become financially smarter through research-backed recommendations on everything from high-yield savings accounts that actually help you to grow your money to finding insurance rates that won't break the bank. Their expert team does a phenomenal job cutting through the noise to help bring you honest and actionable advice that works for real people, not just the pros. So check out any of the links in my description to see how money.com can help you transform your financial future, because when it comes to your money, knowledge truly is power. All right, now let's get back to our video. All right, now number 4 on our list is chasing past performance. This fund went up 45% last year. There is no doubt that headlines like that grab your attention. They create excitement. They make us afraid of missing out. And many people make investment decisions based solely on past performance, and they will jump into whatever did well last year. But what they don't understand is that usually yesterday's biggest winners are going to be tomorrow's losers. Studies consistently show that investments that do really well one period are often going to do poorly in the next period. Guys, this is a statistical pattern that is called reversion to the mean, and this happens across all investments. Remember the 2021 cryptocurrency run back in 2021? I saw so many people jumping in near the peak after seeing so many other people make a fortune, and all they did was lose a lot of money because the prices crashed. And so I say that to say focusing on the basics or the fundamentals rather than recent returns leads to much better decisions. And so instead of chasing what's hot right now, look at investments based on their actual quality. And so if you're looking at a stock, for instance, consider actual earnings growth, competitive advantages of the company, good management. And if you're looking at a fund like an index fund or an ETF, look for their investment approach. Are their processes consistent? Are they charging reasonable fees? That's what you need to be concerning yourself with, because I can tell you, if you are hearing about a hot investment, you're already too late anyway. That's the way it works. And so you want to work hard to resist FOMO when it looks like everyone around you is making quick money, because you are going to be the one left holding the bag at the end when that trend reverses. Guys, remember that real wealth is going to be built through consistently following sound principles, not by jumping from one hot investment to another. All right, and number 5 on our list is ignoring fees and expenses. Look, returns get all of the attention. This fund delivered 12% annual return. This stock jumps 30% in 6 months. This portfolio manager beats the market. And with all of the focus on these exciting numbers, many people barely notice the fees that are quietly eating away at their money. But even small fees can add up dramatically over time. And let me show you some math on this, because it is going to blow your mind. On a $100,000 investment earning 7% annually for 30 years, a 0.5% fee is going to leave you with about $761,000. That same investment with a 1.5% fee would leave you with about $574,000. So that 1% difference in fees cost you $187,000, which is nearly twice the amount of your initial investment. And these fees come in different forms: expense ratios on mutual funds and ETFs, sales charges, management fees, trading costs, and more. And so understanding and reducing your investment costs will significantly improve your results. And so start by knowing exactly what you're paying. Check all of your investment statements and look for the expense ratios, the management fees, and the transaction costs. Then what you want to do is look for lower cost options that give you similar investments. And the great news is that today there are more low cost options than ever before. Nowadays you have index funds and ETFs with expense ratios under 0.1%, and they're super easy to find, guys. You just gotta look. And so as you go through your investment journey, ask yourself, do you actually know what percent percentage of your returns is being eaten up by fees. All right, number 6 on our list is a very common pitfall, and that is going to be a lack of diversification. We feel so confident about what we know. We trust our own judgment and we are comfortable with what is familiar. Most people tend to concentrate their investments in a few companies or industries that they understand well or they work in. But putting too many eggs in one basket exposes you to too much unnecessary risks. For those of you that are old enough, remember Enron, remember GE, remember WeWork, even giants can collapse. In fact, nearly 40% of all stocks experience some sort of large permanent losses over their lifetime. And so by concentrating your investments, you're actually taking on risk that doesn't come with the higher expected returns. The 2000 tech bubble and the 2008 financial crisis both showed how quickly a seemingly invincible industry can fall apart. Therefore, spreading your investments across different types of assets provides you a lot more stable returns. True diversification is going to mean spreading your money across different investments like stocks, bonds, real estate, spreading it across different industries like technology, healthcare, consumer goods, and even different regions like US and international markets. And this approach doesn't just reduce your risk, it actually improves your returns by letting you participate in whatever part of the market is doing well at any given time. And so this is what you want to think about. If your largest investment suddenly went to zero, would your financial future be in serious trouble? All right, number 7 on our list is one that everyone is susceptible to, and that is going to be emotional decision making. Markets drop, your stomach sinks, and you sell everything. Or markets soar, your heart races, and you go all in, baby. Our brains evolved to help us survive in the wild, not to make good investment decisions. And so fear and greed are very powerful emotions that tend to override our logical thinking. But emotions will tend to lead to us buying high and then selling low, the exact opposite of what successful investing is. During the March 2020 market crash, many people panicked and sold at the bottom, again missing out on that amazing recovery that followed. And at the same rate, many people jumped into meme stocks at their peak in 2021. Remember GameStop, AMC? Those people lost money when the prices fell. These emotional reactions feel so right in the moment, but they end up costing us money in the long run. Therefore, you need to create a simple investment plan before market turbulence hits. That way you can stay on track. And so if you haven't done this already, write down your investment goals, your time horizons, and rules for when you want to buy and sell if you're planning to do that. This becomes your guide when your emotions try to take over your decision making. And an even better move is to set up automatic investments and portfolio rebalancing. All of this can be done automatically nowadays, so you can be completely removed from any decision making at all. And so for this one, make sure you ask yourself this question: have your recent investment decisions been driven by careful thinking or by fear, greed, or FOMO? All right, now our last and final mistake is following hot tips and financial media. My brother-in-law made a fortune on this stock, or this TV expert said that the market is going to crash next month. We are constantly bombarded with advice from TV experts, social media influence, and even well-meaning friends and family. But the truth is that most hot tips lead to poor performance or unnecessary trading. There is a study that actually tracked the predictions of financial gurus for over 15 years and found that their accuracy was just slightly better than flipping a coin. And remember that financial news networks need to fill 24 hours of programming, which is going to lead to exaggeration and short-term thinking. And so you have to be aware of the fact that most financial media exists to make money from advertising, not to help you build wealth. They care more about getting your attention than your actual financial success. Therefore, you want to make sure that you are developing your own simple research approach that leads to better decisions. And so instead of being concerned about following tips, just build a simple system for evaluating your investments based on your goals and your comfort with risk. It's that simple. Your focus needs to be on learning timeless investment principles from trustworthy trustworthy sources. And so as you continue to invest, you need to think about this. Are you making your investment decisions based on your own research or on what you heard on TV last night or your social media feed? All right, guys, now we have covered the 8 most costly investing mistakes and how to fix them. And the great news is that none of these fixes require any sort of complex strategies or special knowledge. These are simple adjustments that anyone can make no matter how much experience or money you have. Just small changes in how you invest can lead to hugely different results over time. And just remember that the power of compounding works both ways. It makes your mistakes bigger and it makes your improvements more valuable. All right, so let me know, which mistakes have you been making? Drop that in the comments below. Now, if you found this information helpful, please do me a huge favor, hit the like button, share this video with 3 friends who you know can benefit from advice like this. You never know who you may help along their journey. It has been a pleasure. And if you are still here at this point in the video, you are my people. Drop me a money bag emoji in that comment section. I will see you guys in the next one. Again, I'm Rashida and I'm out.